Cool. I think we are live.
Owen Rask, smooth as always.
Yeah, we've had a few issues behind the scenes, ladies and gentlemen. So thank you for your patience, everyone watching live. Good morning from Hue, Vietnam. Is that how I pronounce it, Justin? Good to see you, mate.
Hoi or Hugh? Hoi?
Hoi?
Maybe.
I don't know. It sounds fun, though.
Either it sounds better than Melbourne right now.
Yeah. So we've had a few technical difficulties over at the studio where Mitchell is. So thanks for bearing with us. Today we're going to do our monthly update, which we're really excited about because we actually missed last month. So it's going to be a really good one this month. And we're going to answer heaps of questions. We're going to talk about the portfolios, the ETFs, talk a bit more about the performance as well. There's a few questions about that in the community. So great to have you with us, everyone. I do have a few slides, but Mitch, maybe just briefly, how's things going?
Yeah, good, mate. I decided to come into the office on a Friday and all the recording equipment, everything's packed up. So I thought I'd stroll into the studio and it'd all be nicely set up for me and I'd just, swan on in and get going. But,
here we are.
Here we are. But other than that, things are really good. Geez, talk about climbing a wall of worry, or has the worry gone away? I'm not sure. The market has just been so strong last few months. We'll talk about the performance. We'll show the numbers, and it's just actually hard to believe. I was actually having a conversation with a bloke the other day on the phone, and he was talking about selling his investment property. It was in Canberra, hadn't worked out as he had thought, and we were going back and forth and lots of conversation. And he says to me, "But geez, it's been pretty average for the market, hasn't it?" And I'm like, "Well, no, you've not been paying attention." And I just quickly looked up the price, the price return of VAS, for example. And I think that year to date from 2 days ago when I was talking to him, I think the price return was 12%.
Yeah, wow.
So actually, and so it's interesting and I was wondering if that what the average person on the street is perceiving, if they're not invested, if they're not, they're just reading those headlines and it's Trump this, Trump that. They're not looking through that and seeing that it's been a fantastic time to remain invested.
Yeah. Yeah, it's one of those things, isn't it, where it's probably a matter of perspective too. If you're buying investment properties and you've got 5 times leverage and you've been in a structural, positive market, probably anything less than reasonably mid double digits is probably underwhelming. But from the actual, apples to apples perspective, the stock market's been absolutely fantastic. And there's been a lot of volatility in between. So that's probably the thing that catches people out is we're thinking about Liberation Day. I made a joke yesterday on LinkedIn that if this is a pro tip for anyone that wants to become a fund manager or wants to become a professional investor, is just wait for Donald Trump to try and do economics and then start that day, because that's when you're probably putting yourself in good stead for some good early returns. Now, I do have a few slides here. You've put some things together, Mitch. So we will just quickly go through the disclaimer because we will be answering questions and talking about performance and all these types of things. So any of the information that you hear or see in today's update is general financial information or general financial advice only. That means the advice is not taking into account your needs, goals, or objectives. So don't act on it until you've spoken to your financial planner, and definitely don't invest in something or make a change until you've read the product disclosure statement. That's the PDS and TMD. So TMD is kind of the document that's new to people. It just tells you what the maybe investment options are and how they might be appropriate for you. So that's a good document. It's kind of like a bridge between what the investment or thing is and who's it suitable for. So that's the TMD. We have our financial services guide, which is available on the Rask website. Don't forget, Rask Invest itself, when we talk about that today, is actually an investment fund investment product. So that has a PDS and TMD as well, which you can access on the website. There's a few key headlines over the last little while that Mitch wants to talk to here. I'll just chime in and maybe hopefully make something slightly more intelligent than animal noises in the background. But you've been speaking to a lot of investors recently. We've been super busy. So what's been on your mind?
I've been keeping an eye on a few key leading indicating stocks for the US consumer. We are going through earnings season over in the US. We've seen Home Depot, the US equivalent of Bunnings, report, it beat expectations, report really robust earnings. It has come through, of course, their peak time when people are getting out in the backyard and polishing the deck and going out and buying a new lawnmower and think, geez, I should buy a drill. But despite that, it actually exceeded those expectations. And we look at these types of stocks, we look at the airlines and whatnot in the US as well, as relatively lead indicators for the strength of the US consumer. Are they pulling back on this type of spending, on this discretionary spend? And that's what at the moment, we're not seeing that happen to the extent of, say, what most people probably expected. So that is a positive, and so that's something that we've been keeping an eye on here. What were my other little notes there, Owen? I've just immediately forgotten.
Good earnings season for mega caps.
Yeah, we've come through the reporting season for the US mega caps, all of them reporting pretty well and getting nice little pops off the back of them. And this goes back to, I think we've been pretty fortunate this first half of the year to have some great guests on the Investors and Retirement podcast coming from the US, in the likes of Mark Kiesel from PIMCO has been excellent. Scott Helfstein as well from GlobalX. And they're providing some really interesting commentary to us from people who, live and breathe the US market and the US consumer. And something that has stuck with me from our conversation with Scott was the fact that the US economy and the US consumer are bigger than any one administration. And so far, that is what we have seen over in the US. So despite the negative sentiment of the tariffs and the implications, sure, we probably haven't seen the implications work through the market because we've had a long pause on them and whatnot. But we've seen the consumer still be pretty robust and the economy still be fairly robust there as well. So, that's what we've been keeping an eye on. The reason for that, of course, anyone invested with us, anyone following along, the S&P 500 through IVV has been, an IHVV as well, is a very predominant figure in our portfolios. So keeping a close eye on that.
Yeah, no, that's fair. It's a similar rhetoric here, I'd say, in Australia, in that some people seem to think, and that's just something I want to talk about actually. Some people seem to think that falling interest rates here in Australia maybe means the economy is in like a really bad shape. I don't think it's really bad shape, and I'll show you. I've got some data to kind of back that up in just a sec. So I think we're going to talk a bit about bonds and stuff today, which hopefully can kind of illustrate and give you the kind of, well, what does all this big picture stuff actually mean for you and a portfolio? But like so this is just the performance of Martian over time. That's not what I wanted to show you. I wanted to show you this just to show you some of the holdings. This is in our 70-30 strategy. It's interesting because Jupiter's the most popular strategy that we have. That's 90-10, isn't it? And
sorry, can you repeat that?
So the Jupiter strategy, 90-10, is the most popular option that people choose when they invest with us, right?
Yeah, that's the most popular. I'd be interested to see, though, had we launched with Saturn first, 100% growth, like all growth, would Saturn be the most popular? Because we have seen a lot of people switch from Jupiter to Saturn. And of course, when we launched, Jupiter was our highest growth option at the time. So, but still to this day, getting good inflows, so new accounts opening up, many choosing Jupiter. I think they like the idea of it not being 100% invested in equities. And so we do have a few levers to pull. When the market pulls back. And by that, I mean, if the market pulls back, we've still got a little bit of cash, a little bit of bonds to be deploying into the market so we can go and attack as well as defend. Whereas if you're in a Saturn portfolio, 100% invested. If the market does pull back, if and when, because it is inevitable, what you'll see is those people having to take advantage of that by putting more money in, rather than just having that ability to rebalance.
Yeah, absolutely. And so that's why probably worthwhile warning is this isn't normal. So just in case anyone's wondering, this is not normal behavior for 3 months. So just keep that in the back of your mind. We'll just quickly go to holdings here.
So let's rattle off past performance, no indicator of future performance.
Yes, indeed. We are going to talk a little bit about the Charter Hall Long WALE REIT, which is a new position that we initiated reasonably recently. We haven't really talked about it. ATEC as well in just a minute. But so back to the conversation around rates, particularly here in Australia, you can see the cash rate was cut recently, which is normally a great thing for three major asset classes, being shares, property, and bonds. So basically everything. And there's been a bit of conversation, particularly in the community, about what does that mean for those different investments now versus, say, 6 months ago. So we obviously moved into bonds, and that kind of did that shift quite a while ago. And that's why when you look at, say, for example, where is the IAF ETF? Here we go. So that's why when you look at, say, the IAF ETF, I remember, Mitch, when we were talking about bonds a little while ago, people were saying to us, you can't do that. Look at the performance of it. And then that was like right here, right? So we were buying it up through here, but obviously it looked horrible in the back catalog because rates had just gone up from basically nothing. So of course that was going to be bad for bonds, but now we're seeing the opposite. I think I'll come back to that in a minute, but that's obviously a symptom of rates coming down. It's a symptom of inflation getting under control. But one of the things that I wanted to just show everyone here, and this comes back to the point around maybe the economy isn't as weak as some people think. So here you can see, I love to track this over time. It's the household savings ratio. So this is just a very rough indication of what Australia saves each week, right? You can pull apart the actual metric and how it's calculated, but it's been going long enough that it's pretty reasonable. And it just gives you a kind of a trend or a trajectory of what households are feeling in Australia. And you can see, obviously, rates really hurt a lot of people, like people that have mortgages, investors, going up. When you are leveraged, that's not a good idea. But now, as we see the unwind and a bit more normalization in the economy, the election's passed, although they've got some more harebrained ideas at the moment, you can kind of see that savings rate is coming back. And that is a very strong proxy for confidence in the economy. So if you're saving money, you're going to be investing, you're going to be traveling, you're going to be doing the things that you want to do. Whereas when you're staring down the barrel of this after COVID, you're not going to be doing those things. So I think this is actually a reminder to people that are thinking about, maybe I put a lot of money in bonds right now because they've done pretty well over the past year. The stock market's pretty expensive, all that. Maybe, but also it's maybe not as sure of a thing as it was back here, where basically every sign was pointing to, well, rates have gone up. They probably won't keep going up forever. So maybe that was the time to start thinking about bonds more so than now, Mitch.
Yeah, I remember that downturn, and I remember conservative portfolios literally falling like negative 10%, negative 11%.
Yeah.
The bond ETFs, that time it was their single worst year in existence. And no one had actually experienced that before. And so it was interesting that I was taking phone calls from investors back then saying, look, my portfolio, my conservative portfolio is in the negative. This should not happen.
Yeah. Yep.
So it was a real education point around that hey, it can actually happen. But it's not something that is usual.
Yeah, we've got a few good questions that have come through here. Good to see Jenny in the chat, Amar, Graham, Owen, everyone. It's good to see you. Some good questions here. Maybe we'll just riff on this real quickly with Amar. So once interest rates come down, will IAF/VBND be replaced? And if so, with what? Why do the portfolios like Jupiter have a cash reserve? And AAA, why not invest all the spare dollars? Don't care about brokerage.
you take part one and I take part two, because part two is more of an operations side of things, and I'll let you sort out IAF and VBND.
Yeah, sure. So IAF and VBND, for folks that aren't familiar, are the two biggest passive bond ETFs in Australia. I'll just show you our screen again so you can see what else is in the fixed income part of our portfolio. So they're government bonds. So what that means for people, when I say bonds, that's what I mean. So when I say credit, typically when I say credit, I mean floating rates. So the actual, the coupon payment that comes to the bond holder is variable. It'll go up and down with inflation or interest rates or something like that. But when we look at, say, a typical bond from a government, it's a fixed rate coupon. So that means that they're more susceptible to interest rate fluctuations versus the credit securities, which I'll talk about in a minute. And so we have a small allocation to different instruments across the defensive side of Jupiter, which is that 10% defensive versus the 90% growth. The same discussion that we're about to have applies to Martian, Terra, Mercury, all those other strategies that we have, which are more conservative. But you can see them in here. So what would likely happen, and this is the thing that we spoke about a lot, Amar, at the recent investment committee meeting, is what will happen if rates continue to fall. So we're already seeing a very substantial impact from rates falling in the form of the performance of the different, I'll just jump down, in the form of the different the performance of our different holdings. So here, let me just zoom in.
Zoom in there, yeah.
So I'll try and maybe get us out of the way as well here, just quickly. There we go.
Probably move us away or out altogether. That way you can get even.
So if you can see here, that's all right, isn't it, Mitch?
Yeah, man.
Cool. So we can see here over the last month, if you just look at the growth side of the portfolio, so basically everything, you could even say CLW, which doesn't have numbers in there, I'll come back to that, up to here.
Yeah, that was a me issue. Rushing to get this table done in time. And of course, CLW being an actual,
REIT
company, a REIT, doesn't publish its, performance numbers, so to speak. And so I was like rushing to get this done. And look, CLW was a casualty.
Yep, that's fine. We'll come back to that because I want to riff on that for a bit anyway. But if you look here, everyone, what you'll see is that over the last month, the things that are typically considered riskier have performed more. And that's because the rate cut that we saw recently is not necessarily about, just well, interest rates come down, X percent, therefore stocks go up. It's actually the impact is multiplied because its expectations have changed. So most consumers who would have a mortgage or something like that have all of a sudden thought, well, what can I do with my money? I'll just put it in these companies. And which companies have gone up? Well, the tech companies, the growth companies, all of those types of things. So that's what we can see in the likes of ATech. We've also had some really good results out of different businesses like Pro Medicus and all that disclosure. I still hold that. So that's what you're seeing here. On the defensive side, however, you're seeing a bit more of a mixed bag. And that's because depending on which market you're talking about, it will depend on what the expectations have happened in the bond market. And so what we're likely to do, if rates kind of trend as expected, we'll probably keep IAF and VBND, Amar. We just may tweak the allocation to it. If we shuffled that somewhere else, where would it go? It would probably go into some form of credit. And the reason that it would go there is because when you have credit products like, say, PCRED down the bottom here, which is it's the PIMCO Global Credit Fund, is as rates come down, the difference between a fixed rate bond and a variable rate bond becomes more pronounced. That's because the variable rate bond has the buffer of the, whatever it is, the inflation rate that it's linked to, or the official cash rate plus a percentage. So as rates come down, that difference between the fixed component and the variable component becomes relatively more significant. And so you don't want to be holding a traditional bond fund at the bottom of the rate cycle. So let me just repeat that. If you're holding a traditional government bond fund at the bottom of the rate cycle and you think interest rates are about to go up or inflation's about to come back, you do not want to be caught holding a lot of fixed rate bond funds like IAF and VB&D. And the reason is that as rates go up, the value of those bonds go down. And that's what we saw here when rates went up. Inflation came raging back after COVID. The bond funds fell. It's not horrendous. Keep in mind the axis over here. It's a bit of a chart crime. But I hope that illustrates the point. So we would look for credit. We would probably look for alternative assets as well that maybe aren't correlated with the market cycle. Now, money, this is a very important thing for everyone to understand. And I know that there were some comments just now about people being a little bit unsure of where the market is. It's pretty scary when you look and you see, say, even, let's just go NDQ, the NASDAQ ETF. When you look and you see this, you're like, oh, is the market going to pull back? Is it going to crash? Is it going to, whatever the case may be? Money has to go somewhere, right? So your money has to be, even if it's in cash, it's technically still invested. It just happens to be in cash. And the longer you hold cash, the greater the likelihood that you're going to underperform. So you have to be really tactical about when you do move to cash. Like we've all got stories of getting spooked and moving to cash and thinking to ourselves, oh, well, that was a bad idea, wasn't it? Such as during the Trump rally recently. So sorry for the long-winded rant, but I know this is an important point for our community, is we still own the bonds inside Rask Invest. We also own variable rate bonds. We also did move recently into infrastructure. Some of you will know. That's right here. We also moved into the Charter Hall Long WALE REIT, which I'll have another rant on in a second, but maybe I'll draw breath and give Mitch a chance to chime in.
Yeah, I just wanted to clarify the second half of that question.
Yes.
We, in all portfolios, this is a Rask Invest specific question. In all portfolios, we do hold a certain amount of physical cash. It's 1% is the actual portfolio amount of physical cash. Your own actual physical cash will vary depending on your contributions, depending on the distributions you've received from the ETFs as well. We will let that sit there until it's large enough to have to deploy because there is brokerage costs, $4.40 or 0.04% of the transacted value. So we don't want to be deploying that, $50 or $100 and charging you 4% of brokerage. We have limits there, so we'll let that amount increase, and before then tipping it across into one of the other ETFs. It could even be the AAA cash ETF. So we are aware of that amount. It will vary from account to account. But our job from day one when you open up an account with us is to ensure that your account tracks the model as closely as possible that you've chosen. So I could see Owen's brought up the Solar account here. We actually have recently, so Solar is 100% a cash account. And the benefit of Solar is, I've got an investor doing this right now. He's tipped in a couple of $100,000 into Solar. He's got a Rask Saturn or Jupiter account. And what he's doing with that is just drip feeding Solar when he sees fit into that Jupiter or Saturn account. So cash is a natural part of the portfolio. Of course, we want to have your account as invested as closely to the model as possible at all times. But yeah, we're not going to do that though if we're going to, unnecessarily have overly large brokerage cost to your account. We've got rules in place around our minimum transaction sizes and rules in place around how far we'll let your portfolio slightly drift from the model before investing that cash for you.
Yeah, there's a good question here about investing for kids from Semi Bluff. I've just put something in the chat there. You can check that out after the live stream. It's a write-up that we covered how to do it, what the different implications are. we get a lot of questions about investing for kids. We also have a separate strategy for that with a lower minimum, just to help parents.
And if you want to go back through the back catalogue, when we launched Luna, the kids portfolio, we did a pretty extensive live session on that. Yeah, it's it's my own son, 3 years old. He was the first. Well, he was 2 at the time. He was the very first investor into. That's the abridged version, the 4-minute one. We banged on for about 45 minutes, I reckon, with the long live one. But yeah, so there's a lot of these little small short walkthroughs on YouTube. You can see there that's his account balance has grown a good amount since then, so it's good.
Yeah, that's great. Oh yeah, so Aisha's asked a question. Can you go over your email from Sunday REIT dividends and how they're going down? Yeah, we can cover that in just a bit. There's a few slides we might just quickly touch on.
Let's go back through these.
So good question, Mitch. First one.
Well, yeah, it's a good question, isn't it? That was I was writing up these questions for you. This particular one for you, Owen. Do you think that the additions, because what we did in May to the portfolios, we didn't exit anything, but of course we brought a lot of changes, and it was a lot of changes to stomach for investors at the time. It was pretty meaty. Have they added value in your opinion?
Yes. But of course, I'd say that.
Next topic.
No, but okay. So let's just quickly dive back into the data again. So you can see this first column here. I'll try and just squeeze it around us. Is monthly performance.
Yeah.
You can see, well, the difference between holding VAS only inside Jupiter, Saturn, Martian versus adding ATEC. The difference, well, Lakehouse is not a good option here, but if you took the 3-month number, it's actually pretty good. Infrastructure, Charter Hall. I'll come back to Charter Hall in just a sec. But yes, we added gold. Yes, gold has outperformed in hedge terms. In unhedged terms, like the bond positions in that time. So broadly, I would say yeah, and that's why people pay us, because hopefully the benefit of those additions, we're making the investments when people aren't prepared to do that.
And
that's where we earn our.
That was the case as well, because if you look back at it, it was coming out of the Trump slump, Liberation Day.
Yeah.
And so Saturn, for example, launched 1st of May. And so, yeah, it was done at a time where we knew as well a lot of our investors would have been either underwater or borderline in their returns, and so we wouldn't have been locking in as many CGT events as well for the portfolios.
Yeah, it's and that's the key point, is we're trying to minimize tax on the back end for everyone and fees, but we can see here, like over 3 months, this is what I meant before for everyone's benefit. Like when you have Donald Trump trying to do economics, wait for him to try and do that and then start your position. Because what you'll see is you'll see the companies that are most sensitive to those types of things will get sold down. And we saw that with tech stocks because they were pretty expensive at the time. And so making that shift was really, really important to us. And I remember the investment committee welcomed this proposal, which I wanted to put to them. But some of the community at the time was saying, well, if you add something like ATEC or Lakehouse Capital or something like that, are you stepping away from this true passive focus? And I often think about this idea of what is active and what is passive. We tend to think about it in different terms. It's not just those two camps. There's this whole thing in between: sector funds, factor funds, quantitative funds, all different types of things, thematic funds, so many different types of ETFs or types of funds or types of companies and everything that you can invest in. And we're just constantly looking for the best expression. So imagine if in the downturn, your decision-making was, well, yeah, I'm a pretty brave investor. I'm one of the few that would actually see this as a buying opportunity. I'll just stay the course and invest in something that I know, maybe VAS, maybe A200, something like that. Or you think, well, what's the best expression at that moment in time? And for us, when it comes to an ETF like this, we've invested in technology companies for my whole career, really. So for me, simply saying that we want to get exposure to tech companies is not necessarily a decision between active or passive. It's actually just saying, I want an index fund that just happens to have technology companies in it. And that's what we got with this fund. So this was the best expression at the time versus some of the alternatives we spoke about. And so you can see that here on the active side. Short-term results aren't always indicative of what you probably want longer term, but we've made our case for why we hold this active strategy. But to try and illustrate this point, one thing we haven't spoken about is Mitch's absolutely wonderful work in designing the new pages on.
I gathered the data. I don't think I can take any form of credit for design because I.
But it does look bloody good. So so when you come onto the new Rask Invest pages, everyone, when you scroll down a bit, just zoom in here.
I wrote the words and gathered the data. So I'll take credit for that.
Yeah. Well, if we come down here, we can see the holdings. We can see the sectors, which is great for look through in the portfolio. But you can also see methodology, which is the one that I really wanted us to have, just to help everyone understand. We don't just try and stick with index funds. We're not an active investor in every regard either, but we try and get the best expression. So you can see that here, and you can see that makeup over time. And interestingly, you might find that it's not necessarily our high growth options that are more active. It may be more of our defensive options where we want things that aren't just like vanilla bonds or something like that. So that's a key point.
The interesting thing is the most conservative portfolio has the highest allocation to active.
Yeah.
And that's because the Mercury, I think it's literally called conservative, has the highest allocation to the PIMCO ETFs, which are actively managed ETFs.
Yeah. We've got a good question. You've got a question here, will the portfolios become more active? But there was a good question here from Andres, which says, what's the process behind selecting Lakehouse compared to other funds such as Munro or L1? Another one that is often compared to is Hyperion. So the simple answer to this is actually probably not what you expect, and it's just based purely on trust. So Donnie Buchanan, who is the co-founder of Lakehouse Capital, I've known Donnie because I used to work with Donnie at the Motley Fool, and I hold Donnie in the highest regard, not just for his investing, but also for his integrity. If anyone's met Donnie here, he's a salt of the earth, lives on a farm, concentrated investor, no BS type of guy. And his approach is wonderful. The transparency is excellent. The professionalism is the best I've seen. And I honestly just trust them. And I've known them for a very long time, both Nick and Donnie, Owen and the team at Lakehouse, and before that, Joe Mager. So I have a lot of trust in them, and their results speak for themselves. I understand the process inside and out. If I wasn't running Rask, I'd probably want to get a job at Lakehouse. So Donnie, watch out. If Rask ever falls over, that's probably where I would go. So they're absolutely wonderful. That's like Munro, Nick Griffith, wonderful. L1, yes. Hyperion, yes. There is a fee differential between all the different strategies. I would love to invest in Chow Ma's fund as well, if it would ever become a listed fund. We can do that for our financial advice clients. We can't do it for Rask Invest. So there's a lot of
also, Owen, some slight style differences as well. Like these guys are more, I would say, traditional kind of GARP or value/GARP kind of operators. But then you've got, when you actually listen to the Munro guys and whatnot, there's people there using stop losses and all this kind of things. And I know me and you're relatively cut from a similar cloth when it comes to active equity investing. And this approach is something that we're far more comfortable with. Doesn't mean that those other ones aren't good funds. Doesn't mean that we maybe won't cover them. Or they might be in our approved product list for when we launch our custom version as well. So it's just our comfortability level with where we're applying investors' money.
Yeah. And the final piece of the puzzle here, guys, is that we have IVV, we have other funds and holdings in the portfolio. So overlap is really important, as Semi-Bluff alluded to before. If you look at the major holdings inside Lakehouse Capital, there's only 18 holdings in the global fund, which is quite concentrated. And amongst those 18, there is more concentration. Mercado Libre, which is a company that I would love to own. Pinterest I did own and got burnt, but that's okay. Amazon is probably the most meaningful of all the companies inside IVV that appears in Lakehouse. Alphabet too, but I don't think it's as big of a holding. So it fits really, really well with our existing portfolio. So I hope that makes sense. Where some of the other more growthy ones own a lot of those mega cap stocks just to keep up with the market. So that's what I'd say. So Jeremy, why is it such a why is it a smaller position? Because that's actually a really good question, Jeremy. And that's because there's probably more to come, as in not necessarily with Lakehouse, but don't be surprised if we add other kind of best of breed funds in the global allocations, especially in Saturn, the all growth strategy. You can expect us to do that
as well. I mean, we do want to keep an eye on our fee budget as well. We do understand, even though we're not absolutely wedded to everything being the absolute lowest cost, we do build these portfolios with a fee budget in mind. So that's really important, and I think that's an important lesson for a lot of investors themselves to apply to their own portfolios. You see people really rigidly sticking to the absolute cheapest of the cheap, and that's fine when you're looking at your large mega caps and whatnot, and they're trying to get that MER down as low as possible, but come up with a fee budget. So it might be 0.2%, and you can have your 0.04 IVV in there. And you can then offset that with something that's a little bit higher, closer to your 1% in active. So, you can kind of have your cake and eat it too, if you apply that fee budget kind of rhetoric over your entire portfolio.
Yeah, absolutely. So there were a few more things we want to get to here. We'll come back to the question for Michelle, which is from Jeremy. A300 is now a cheaper version of VAS. Do we switch, Mitch? Maybe you can chime in on that.
So I hope I got I've never not even actually looked up the ticker code, but we're talking about the Global X's new ASX 300 essentially index tracking ETF. So I presumed it was called A300. I just had a stab at that.
Did you really? You just guessed, and that's what you got, because it is right. Yeah.
I presumed it was. But what the answer to that is no. We wouldn't be switching. You could, if you look at the fee differential, you've then got there's that one element involved in it. But you've got to take into consideration our switching costs. So a lot of our investors now are sitting on capital gains, and so there'll be tax events incurred. There'll be brokerage costs incurred. And so you're probably going to have to hold A300 for a couple of years or more before that difference is made up for in the fee. So what I do see, and it's fantastic that that Global X are going down this path and launching these really vanilla index tracking super low cost ETFs, putting a bit of pressure on the incumbents, on your iShares and your Vanguards. I wouldn't be surprised if Vanguard eventually matched them. They do have a history, of course, of their structure of lowering fees over time. And we've already seen that in a number of their products. But as well, what I do see is new money, new investors coming into the market. If they're lining up apples with apples, if they're lining up IOZ with STW, with VAS, with A200 and A300, I'd imagine they're running the ruler over it, going bang, cheapest, buy.
Yeah.
And so new money will flow into it.
Yeah, there would be. Okay, so Jeremy, any thoughts on why VAS might not drop down to 0.04? So basically the way they configure their pricing, my understanding at Vanguard is that once they reach efficient scale, then they drop pricing. So once it's at a certain level and they can afford it with the running costs of Vanguard, then they bring their prices down. So that's how it works. But I agree with you, Mitch. A lot of new money would flow into this. A lot of probably big investors who are in pension phase in their superannuation would use this because if they can find a virtually fixed cost broker, like a South Wealth or something like that, and they can place a big trade in one go, and they've got no tax implications of doing so, they might consider the switch, but it would have to be a meaningful chunk of money there. So we've already talked about our portfolios reacting to lower rate environment. It's positive. Like we've positioned purposefully for this.
I think we've covered off those pretty well.
So we've positioned for that deliberately. So for everyone's benefit, we've taken care of that for you. So that's the point. So we think that we've got a good mix of variable rate and fixed rate. We've got a good amount of growth exposure versus income exposure. I would like the income tilt to be higher. Of course, all of us, we'll talk about that in a sec, would like that. But we've got all of those really well diversified positions. So I thought I'd maybe just take a minute just to talk about CLW, which is something that we haven't spoken about recently on a live update.
Yeah, so we've probably got a short amount of time left, so we're going to CLW, and then you did threaten a private credit rant, I believe.
Yeah, so why don't we do both of them in one? So so at the moment, there is a lot of talk around investing broadly in private credit, and we've had a lot of people talk about private credit on the show. A good example of what private credit is if everyone that listens to the Investors Podcast goes back a couple of years and thinks about the Invesco senior secured loan strategy. That was one of our most popular episodes of all time. Then another more recently was with Nehemiah from Term Plus, which you'll see more of Nehemiah in the future, I hope. So that's great. So we're seeing more of that come to market. And what is private credit? So private credit is effectively loans to businesses that aren't listed on the stock exchange. So you'll have big pools of capital that then are looking to lend to businesses. And a good example, I think, from Invesco's conversation was, I think it was Hungry Jack's or Burger King. Massive business, needed capital, not on the stock exchange. Where do they go? They go to private credit. So they'll go into this market and they'll try and get loans for lending. Not all private credit is considered equal. A lot of the private credit that I'm seeing when I'm speaking to people is what I would say very, very, very opaque. So most Australians have, if they do have some association with this market, what they typically associate it with is real estate lending. So first mortgages, commercial real estate debt, development debt, construction loans, those types of things are very popular in Australia. And the reason is because the big banks in Australia pulled out of that market after the GFC. They learned their lesson. The banks learned their lesson, and they effectively got more regulated. And you can go and watch a documentary like The Inside Job. I think it's called The Inside Job, which I watched recently. This is about the GFC and why they pulled out of that. So what's happened is, as those big funds big banks have pulled out, is these funds have gone in and said, well, we can lend to those businesses. But for the everyday investor, and I would say the majority of financial advisors, you have absolutely no idea what's going on. And while that might sound a bit harsh, it's true, because it's not that you're not intelligent, it's just that you don't know. The whole point of private markets is it's private. So you're not privy to the information. You can't just go into your fund manager's latest update and go, oh, they hold Amazon. I'll just go to the Amazon website and find out what Amazon does, and I'll check their financials and make sure it's all legitimate. So what gets passed off sometimes is not always what you expect it to be. So this is an important thing to understand. I just want people to keep their wits about them when they go into these markets and really deal with really good operators. But we don't hold private credit, but I'm going to give you an example of maybe why we positioned in CLW recently as we suspected rates would come down. And hopefully this is something that everyone can take away. It's a bit of an educational lesson of how you can use that top-down intel, I guess. So we got a small position in CLW, which is the Charter Hall Long WALE REIT. I'll bring it up so people can visualize it. Charter Hall Long WALE REIT. So this is the fund here. It holds about 500 properties or something like that. Yeah, 510. It's got a lot of money invested in these properties. This is probably the key point, the WALE. It means weighted average lease expiry, or in other words, how long is the average lease? I joked with Drew a couple of weeks ago on the podcast that our business, Mitch, Rask, is never signing a 10-year lease.
I listen
ever.
I like that.
You'd have to have rocks for brains if you're in a small, medium business to sign a 10-year lease. But for the ATO, for big manufacturing here, this is you can't actually see it too well here, but on this backdrop, that's Arnott's. Yeah, so it's an Arnott's factory. You're at Arnott's, you want to know that, right? So you want to know that you're in that building and it's yours for 10 years, maybe longer, maybe 20 years. So that's what this does. It owns those properties. Those properties are leased out on long-term leases, and they collect the rents and benefit from the property going up over time. So one of the things that you might see if you just do a quick little Mr. Google here, you jump in, you'll see that the Charter Hall Long WALE REIT over 5 years has been pretty ordinary. Over 1 year, it's been pretty good. So we moved into it earlier this year, somewhere around here. If you look, that chart doesn't seem very compelling. And again, it's because interest rates went up. Everyone after COVID was like, well, the office is dead. No one's going back to the office, which, there's some people have gone back. It is definitely quieter in some property markets, particularly in office. In warehouse and industrial, it's still, it's the glory days, to be honest. So Charter Hall has a bit of exposure to that. So why would you allocate to this? So just at the highest level, you get the pass-through of rent, which you can see here is 5.46%, according to the Honourable Dr. Google, which we know is very, very incorrect more often than not. If we zoom in to the dividend yield through time, we can see that as the share price fell as out of COVID, the yield picked up, right? Because effectively the properties inside the REIT are still paying rents. They're on 10-year leases. There might have been some bad leases and that sort of stuff, but these are really big, reputable organizations and government organizations that rent these, like Arnott's. I feel like I ate more Arnott's biscuits during COVID than less, to be honest, as I was locked up at home. So, there are certain instances where that logic just doesn't flow. But obviously the share price got punished and the dividend yield spiked. So instead of running away from the fire, you could have slowly waded towards it. And this is the key point and how it relates to private credit. When you invest in private credit, you do not get the upside in a company's share price. Because when you invest in private credit and in the private credit funds, what you're getting, Mitch, is you're investing at the valuation of the private credit loans. So you are basically 100% income. You're 90% income. That's why if you've ever heard someone say it's an inch deep, a mile wide, what they mean by that is like you might have a private credit fund that has 100 loans in it, 200 loans, 500 loans, depending on the size of it. Whereas when you invest in a REIT, you have the opportunity for some growth, which is what we've seen recently, which is why we positioned in it. So effectively, you are able to, where did I go? Here we go. Effectively, you are able to buy into this REIT at an above average dividend yield at a price that was below the value of the properties. So you get the income, assuming you believe that the income was sustainable, but you also got the uplift in the valuation. So let me show you what that looks like just quickly here. And I won't spend too much longer on this. I just wanted to use it as a really good illustrative point for people of how it works. So if we've looked, that's the wrong chart, sorry guys. Not to current asset value, where are we? Book value, there we go. So if we look here and we zoom in, if you see that there's a 1 here, that basically means that the share price matches the value of all the properties inside it, the net tangible assets, minus the debts and all that. And you can see right now, as we record this podcast, we are smack bang at 1-to-1. And basically what that means is the share price today represents the best guess of what all the properties are worth. But if you go back, over the last year or so, you can see that it was trading at a discount. So not only did you get the income, but you also got the rebound in the sentiment and the belief that the properties were worth what they said they were worth. And so by using a product like this, you were able to get probably the same, if not higher income. You were able to get a kind of retracement back to the actual valuations. And the third thing is you were able to have the whole time daily liquidity. You could have sold out at any moment that whole time. There are certain instances where private credit is absolutely wonderful. I recently opened a Term Plus account, Mitch, as you know, and it's absolutely wonderful. And there's different parts of your portfolio that probably could be allocated to that. But for our purposes, this was our way of trying to explore that side of the market as rates come down. And we're very happy with our holding, I should say. But I just wanted to illustrate this point is like, there are some tools available on the stock market that you should be taking advantage of, whether rates are going up or down. This could have gone the other way for sure, but a bit of research goes a long way. That's all I got. That's my rant done.
That is a wonderful rant. And for anyone who's watching, this is Ticker, which we've been using a lot recently. They've come on board as like a bit of a research partner for us here at Rask. So Ticker, TIKR. And if you go ticker.com/Rask, I believe you can get a little discount on it at the moment. So it's a tool that we were using prior to them coming on board, and
been using it since it was released, to be honest.
Yeah. I've one thing I actually really like about Ticker, and I've been using a lot the last few weeks, is actually the transcripts. Going through, you're seeing a lot of companies reporting, and they go and you can read a transcript of the earnings call. And usually, this is where the CEO, CFO, etc., front up to analysts, and analysts throw questions at them. So, I find this really, really handy. I'm eagerly anticipating, I reckon, an AI tool from Ticker to actually be able to, summarize these for you, or go through them, or highlight interesting points and whatnot. So you can do a search. Okay, there you go. I didn't realize that, but
yeah,
excellent.
Aisha's has said something really interesting. Sorry, I had a bit of a quick laugh at this. On the Gold Coast, I find private credit scary, as so many sky-rise developments go into administration. Yeah, so that's, we've all heard the stories of timeshares and those types of things on the Goldie. Aisha, don't worry about that. But the thing to keep in mind is, one of the reasons I wanted to air that is I think a lot of people are going to look to private credit over the next year or two, and fair enough. It's going to be compelling as rates drop, because a lot of retirees listening to this will need income. Like everyone needs income. So I just want everyone to be mindful that there are lockups on all of these types of products. And a lot of water can pass under a bridge as a market cycle transitions from growth to contraction, higher rates to low rates. And so the longer you're locked up in strategies, you can substantially increase your risk without knowing it. You just don't get them telling you each and every day what the value of that investment's worth.
There's also been a lot of, I want to get to it. There's a bit of side discussion here that I think you'd be interested in, Owen. You've probably seen it. But I just wanted to also say, if you, there's a lot of people out there talking about private credit at the moment. It's, certainly grabbing a lot of attention. What you'll hear a lot of the experts say about it, though, as well, is look for people who are operating these private credit investment vehicles to see if they've had workout experience. And, they're not talking about me not having workout experience physically. Yeah. They're referring to have these guys been involved in portfolios, in private credit deals when it's gone wrong. And they've had to work out the situation. So you've got a lot of people bring forward private credit products to the market because the yields are incredibly attractive, but you really have to dig deep into who they are and what they've done in the past. Really importantly, it's really, really. So they're not all created equal by a country mile. Now, what I wanted to get at, Owen, was because I think people might be a little bit surprised that this has come up in our investment committee conversations. There's a side chat going on in the comments here about crypto. I thought I'd people, you might be surprised, but Owen did actually bring up crypto in our last investment committee.
Yeah. So,
Jeremy, I'll just give you a quick note. You are not the first person to come up with that potential name for a portfolio. I did beat you to it, I think, even when I interviewed with Owen. So,
Uranus, you mean?
Yeah.
That's the next one. Yeah. So in the most recent investment committee, which was a while ago now, I put forth that maybe we should have some Bitcoin in our portfolios. We would do it through an ETF just to keep it transparent and easy with our community, if you wanted to transfer it in or out. And when I say some Bitcoin, I want to be realistic with everyone here. I mean like 1%. Like it's not it would only possibly apply in our Saturn strategy. And the only thing that we would consider allocating to is Bitcoin itself, with not any of the other cryptocurrencies. They're a totally different thing, just Bitcoin. That said, like I obviously named my son after Charlie Munger, and Charlie Munger believed that cryptocurrencies and Bitcoin generally were the biggest threat to the United States financial system and an absolute scam of the century. And I do kind of agree with him. And I think most of the people that shill Bitcoin are charlatans and they're not the type of people I hang out with anyway. So I'm quite happy to distance myself from that. But I just think when we look at alternative means of exposure in portfolios, the longer that it exists, the more legitimacy it gets. So it is potentially something that people can allocate to in a portfolio. We don't endorse it necessarily at scale, but I just wanted to bring it up. And it's not, I can tell you based on the committee's response, that it will not be added to the portfolios anytime soon. However, it may be added as part of our custom portfolios in the near term. So you may be able to just go in and just add a little bit extra to your Rask Invest account and just say, I want 1% in this Bitcoin ETF, and we'll do the research and give you what we think is the best Bitcoin ETF. And final note on this is Bitcoin is obviously extremely risk on. So what that means is when the going's good, the going's very good. When the going's bad, it's horrendously bad. So people know that, but just to cover off any doubts or uncertainties around that. So it all comes back to how you position it in your portfolio. I believe that we are still going to make a lot of money over the next 10 years if we don't hold Bitcoin. Like, look at these wonderful companies we own through ATEC or Lakehouse or VAS. You don't need to do any of this. So, just to be real with everyone, we have considered it. I can see that the chat's lighting up. The straw man would back you, Brad. Yes, he would. Mr. Andrew Page. Mr. Andrew Page has done wonderfully well out of Bitcoin, as have many people. I don't know, Mitch. We can maybe do another session on this, but there's so much for us to invest in that it's just one of the many things, and we're not suggesting in any way that it's the only thing that people should do. I think that's what I really wanted to get across too. So
yeah, I think if you go back to, say, the conversation we just had about Lakehouse, right? LHGG, why we invested in that, it's because we know it inside and out, and you've known the people running it for years. And for me, when a huge part of what I look for in an investment, especially in a managed investment by someone else, is the people and the process. Yeah, and so you're ticking those boxes, and so that gives us that comfortability. And when you're comfortable, you can go harder at something. You can invest with confidence.
Yeah.
If that was the reason why we've chosen that particular investment, then standing back and saying, okay, let's allocate 1% to this or 2% to this or something like that. And so you're seeing the live conversation that took place in the investment committee meeting.
Yeah.
I just don't have the same conviction. But I'm clearly a lot of people do.
A lot of people do, yeah, and it's just worth suggesting there that it can be used in portfolios, and you just need to be mindful about your position sizing and all those types of things. So maybe we'll just go for another 5 or 10 minutes, Mitch. Sorry to take you over time, but there's some questions we haven't got to.
Yeah.
Jeremy's question is coming back to an earlier question. What do you see as the go-to in 5 years? Still stock exchanges, or are there new markets on the horizon? That's a good question. From my 2 cents is that we've seen a lot of the big exchanges experiment with launching different platforms, like blockchain-based platforms. I think that is still the viable strategy for private market investors. So we talk a lot about here on the Rask network generally, over probably the last 5 to 6 years, we've talked about how the private market is definitely a frontier that a lot of the Rask community want exposure to. There's just no easy way about it. And in academia, everyone should know this, that there's something called an illiquidity premium. And what that basically means is the more illiquid your portfolio is, the higher your expected return should be. And so effectively, what you get from private markets, the fact that it is hard to get exposure to is the reason that you get the better return, right? So that's the first thing. And so I think stock exchanges around the world are noticing that, and they want exposure to all markets, not just the stock exchanges. The ASX is obviously under a lot of pressure right now because after that failed blockchain and then a bunch of other things that they tried, I don't see massive changes in that regard. I think that
see more competition coming in. And
SIBO's coming. Yeah, here in Australia.
In mid-September, I've booked in SIBO for a podcast on the Australian Investors podcast. Bringing competition, and competition will bring innovation. Maybe not from the ASX.
Yeah.
But, and then you're seeing the Canadian Stock Exchange actually looking to buy the NSX here, the National Stock Exchange. There's been alternatives, but they've just been incredibly poor or terrible. But all this innovation, I think, will open pathways. And I remember I was listening to a podcast from the US yesterday, the day before, with your favorite, the Ritholtz guys, Owen.
Wu-Tang Clan of Finance. Yep.
Yeah. And they were discussing that they think the most overblown conversation at the moment is the public versus private market debate. And if we fast forward in a few years' time, they really foresee investment vehicles coming around that give public markets access to private. You're seeing people like Pengana actually start to really innovate. Just yesterday, they were in the news with a bit of some innovation coming into their one of their listed investment companies. I think that structure is really interesting for private markets. So I think you're going to see people maybe play around with traditional structures and launching products on these competitive exchanges.
Yeah, definitely. Just quickly on this question here, good question from Andrew. Why is financial planning getting so expensive? Because since the last, say, 5 years, the number of financial planners has fallen by about 60%. So there's 60% fewer financial advisors. At the same time, post-Royal Commission, the compliance burden has gone through the roof. So the amount of stuff that we have to contend with now to offer financial advice in Australia is mind-bending. And so just to get over the compliance hurdle probably explains all of the price increases that you can see here. And this is a recent article only from a few days ago about the ongoing fees of financial advice. And you can see since 2020, risen from 2,800 per year on average to 4,600. That's just the financial advice fees. The average Australian advisor is 52 years old, earns $145,000, which is, it's a good salary, very good salary for some, but many of you would know that a lot of other professions earn more than that. So at 52 years of age. So keep that in the back of your minds. Just briefly, everyone, there's been a lot of people joining the Rask community lately. So if you want to keep having the chat, jump over in there. Mitch and I are in there every day. There's some really, really great questions in here. I think that was basically all the questions we've covered. Tony talked about the Vanguard FTSE Europe Shares ETF. I brought it up on screen before. It's actually done very, very well. We don't have distinct exposure to European stocks. Like we don't have like an index fund for Europe, but we do have exposure to it through some of the Lakehouse holdings that are across there. And keep in mind that inadvertently, we get a lot of exposure to places like the UK and Europe through IVV, because IVV owns Microsoft, Apple, Amazon, Tesla, all these types of companies that are exposed to that ecosystem and that economy. So we get a kind of good focus there. I hope that makes sense.
I just want to clarify for a lot of people there's a few people there saying a Rask Investment Committee podcast episode would be quite interesting. I can tell you there's a lot of compliance that goes on in there, so you might want to fast forward a fair bit of that episode. Maybe we can jazz it up a bit for you, but it's as most things, it's probably not as exciting as it sounds.
No, it's, to be honest, everyone, the investment committee is 70% operations, 30% investments.
A lot of compliance.
Because normally by the time it comes time to the committee's had time to review the portfolios and any proposed changes. So the actual conversation itself is not that riveting. It's already been had, so to speak. So it's just clarifying points. But there's a question here from Owen about private markets. You might remember quite a few years ago, Owen, this is 2022, so 5 years ago.
Have you just asked yourself a question?
No, this is Owen in the chat here.
Owen, all right.
Yeah. I do talk to myself most days of the week, but you can see here that this chart tracks basically the value of private markets in the United States. I think this is from Hamilton Lane themselves. And you can see where, I guess, the value is in this marketplace. You can see since the GFC, it's accelerated because a lot of changes were made there. But you can see venture capital, for the most part, we're talking about businesses like Canva here in Australia or Palantir before it listed on the stock exchange, like all those wonderful companies that you'd love to invest in, all those bros talk about overseas. That's this slither here, but there's still so much else in here. Private credit is this orange that we were just talking about. Real estate down the bottom. These are all like buyouts and mid-market funds. But the crazy thing is, and I've talked about this before in our emails, is there are some 18,000 private companies in the United States with revenue over 100 million versus 2,800 in public markets. So just if you just took that alone, you would say, well, if you're the New York Stock Exchange or the NASDAQ Stock Exchange, or here in Australia, you're the ASX or you're the CBOE Exchange, you'd be saying to yourself, if you're the CEO of one of those stock exchanges, you'd be like, well, how do I get some of that? How do I tap into that market? And then you go to the second part of the sentence, which is the number of public companies is declining. So they're getting even fewer fees. So that ties in with the whole thing about why people want to get access to private credit, private equity. It's not just a new thing. It's been going on for 30 years, but it's definitely much more in vogue than ever before. So that's one thing that we can probably leave people with.
Awesome, mate. I think let's look to wrap it up there. We've gone for, what's that, an hour and 9 minutes. It's a marathon, giving the people what they want.
But it's been good to be back, Mitch. So
it's been a little while. So absolutely keep the conversation going on over in the Rask community. And, I get a message, I get a notification every new member that joins, and geez, the phone's been going off. So make them all feel the people who are on this live chat here and whatnot, they're, I see lots of the names there. They're very vocal in the community and posting a lot and joining in and participating, which is great. So make sure every new person who posts, welcome them, and because we want to really foster a community that's really supportive of people and lifts people up and helps them out. So and make people feel like they can ask the questions, even if they might just ask the questions.
Just ask the questions. Finally, there was just a quick reminder about the CBA, the dividends falling in Australia. So dividends aren't actually falling. That's the key point. The valuations are stretching. So the yield is coming down. The conversation we had about charter holders before, about ATEC, about diversifying away from all of the sectors to just the ones you want. We can go into this again in either podcast or whatever, but the big genesis or the big kind of takeaway from that discussion that we've been having in our email every weekend on a Sunday is, over the next 20 years, at least from this point, I suspect that most of the return that you will probably get from stocks is going to come from the growth component. Whereas historically, a meatier chunk of that came from income, about 4 to 5% of the 10% return. So about half was income. So going forward, I think majority will be the growth component. Maybe it's 7 out of every $10 or something like that. Obviously, just some loose figures, but it's just really important for people as they walk away or leave today's live show, maybe just to read that email from the weekend if you haven't had a chance to open it, because I think that's the big implication for index-only investors over the next few decades. So not doom and gloom, just understanding what it means for your portfolio. Okay. Thanks, Mitch. Thanks, everyone. Keep the chat going over in the community. We're in there all day, every day. So
I've just seen a couple of people asking about some Rask merch. Amar, there's no puffer vests, just FYI.
We have talked about it, though.
But there is, behind me there's a few shirts, a few hats, some old logo beanies, collector's items these days.
Teeny weeny beanies, yep.
Email me, mitchell@rask.com.au, and let's see if we can sort something out. And if anyone watching this today who is not a Rask Invest investor and is interested, jump across to rask.com.au, check out the investments page, look through the portfolios. You can book a call directly with myself if you like. And the number one reason a lot of people are investing with us is they don't have the time or the confidence to get out there and put this into practice themselves. So we absolutely love to help you out. So join us. What's going on in the comments? I can see you laughing.
Stall Dualities just said, any plans for a Rask shacket? Well, for those that don't know, for those of you that actually do other things in your life, Drew's been wearing a cross between a jacket and a shirt into the studio every week. And I learned on the weekend, actually yesterday, that it is tailor-made, and he left it in the office and I popped it on and I stretched it, and I don't think he's too happy about it. So it's an ongoing joke on the Investors Podcast. The Investors Podcast is out tomorrow morning at 7 a.m. It's an absolute cracker of a session. So we cover a lot of reporting season, a few of the things that we talked about today. So get along to that. And the podcasts are really, really amazing lately. So Mitch has done some crackers as well. So enjoy that, guys. Reach out if you need anything, if you want to invest, if you want to talk finance, or just jump into the community. We'd love to hear from you. So have a great day, everyone. Enjoy your weekends. Stay warm.